The early morning train. If the levels of stock prices are any indication at all, well then global COVID-19 worries should all be behind us. Many of the world's largest stock indices, including the NASDAQ, the S&P 500, the Nikkei, the DAX 30, even the Shanghai Stock Exchange Composite, they've all recovered most of their COVID-19 losses, and some have even topped their pre-pandemic levels. Traditional wisdom has it that share prices are one of the best predictors of the future. So a rising stock market might reflect that everything is under control and the economic crisis is even drawing to a close. Yet the gulf between the real world and the global capital markets, at least as evidenced by these stock indices, well, it's very wide. Moreover, there's another bit of wisdom that we've quoted in the past, that the stock market has predicted 9 out of the last 5 recessions. That's from Nobel laureate Paul Samuelson. He said that back in 1966, and it continues to be true today. Maybe the odds are the same on the way up as the way down. While the unprecedented liquidity injections by central banks, they've all helped stabilize the global capital markets, the economic wounds from the COVID-19 pandemic really have not healed. This is shown throughout our macro deck in a lot of different ways. But to sum it all up, the global economy is expected to shrink by 5% in 2020. That's the worst recession since World War II. The disruption of economic activities due to the shutdown measures has severely impacted corporations and municipal financial health. As a result, solvency risks have increased, and liquidity alone cannot solve a solvency issue. Companies can't survive on subsidies and low-cost debt forever. Eventually, they need to create more revenue. For real estate investors, as weaker economic conditions filter through to occupier demand, the net operating income for real estate could deteriorate further before we get an actual sunrise. In sum, real estate could be the caboose on a recovery train that has not yet left the station. While waiting to catch the early train, investors may seek to trade out of asset types that could be a drag on future performance, while they should also reserve seats in the head cars where the ride could be smoother. To mix up all my metaphors here, investors should be aware of the false dawn, just as it's premature to declare that COVID is under full control just yet. Yet, the sun will rise again someday, and so investors should be well positioned to catch an early train, even if it means standing in the dark at the station for a little while longer.